morning, and I'd like to thank everyone for joining our third Thursday marketing meeting for June. Brooks may or may not be able to join us. We are having our annual marketing meeting, and that's actually taking place here in Omaha downtown, but I am in my normal office here at home going about things. So we're going to talk about the thing that's on everybody's mind here right now, and go ahead and share my screen here. And that is the drought monitor that has come out today. And as we can see, we have conditions that are reflecting extreme dryness across the main part of the corn belt, starting from, west central Nebraska, stretching all the way, really all the way to Philadelphia. And we're beginning to see signs of drought in parts of Wisconsin and stretching all the way south down into Illinois. Now, this is a problem, and this is something that we have probably already taken the top ideas for yields for corn off the table, meaning the USDA was coming in at 181.5 bushels per acre. Given where the drought is occurring, particularly seeing this in central Illinois and in Indiana, that's one of our prime production areas. It hasn't taken hold yet here in north central Iowa, which is another bigger production area. But as you can see here in eastern Nebraska, where some corn is irrigated, some is not, we have the most severe problems. So the big question that's been coming on everybody's mind is this a repeat of 2012? So take a look at it and show you a couple of maps here that we can compare. This is the June 12th, 2012 drought map, and as you can see, we had drought in place in Kansas, most of the southwest U.S. We had not yet reached drought conditions yet, save for central Illinois and right here into north central Iowa, which again are two big production areas. We had just seen signs of drought. So we compare that to where we are now. Yes, this situation does appear to be a little more dire currently than it was from 2012. Now we're going to move out. This is a drought monitor from July 17th of 2012. So going forward, this would be where we would need to be a month from now. And again, as you can see, drought has taken hold throughout basically the entire state of Illinois, all of Iowa, most all of Nebraska. So these two maps are different. And the weather conditions and the weather setup is different this year than it was from 2012. First of all, drought in the Midwest. Very often we see drought in the southeast down here in South Carolina and Georgia. There's a thing out here, the island of Bermuda sits off the east coast of the U.S., and there's a thing called the Bermuda High. And high pressure typically sits there. The position of that high pressure ridge is different this year than it was from 2012. So that does create the potential for rain and a change within this weather pattern. So that is one major difference. So what we're going to fall into here most likely is we have a jet stream problem right now where the jet stream is moving south through Texas, and we're pumping plenty of moisture here. And we have record heat in Canada, and that heat is pouring down into the U.S. along with the dryness. Now, as the weather condition moves slowly from La Nina into El Nino, that does create the potential for that jet stream to move back north, and we do have the potential to get the rain that we actually need. So the fallout for the markets are, and I'm going to switch my screens right now, and we're going to go ahead and take a look at some charts here. And as you can see, this is new crop corn today, and the market has moved noticeably higher. Again, we are seeing weather and rain come out of the forecast. Weather markets can be very difficult, and they can be very violent, as there are 4 weather runs in a given day. They start at 00 at midnight, 6 a.m., noon, 6 p.m., and then back to the 00 run. So if we see weather or precipitation taken in and out of these runs, that will result obviously in extreme volatility, especially starting, let's say, a week from now, moving all the way through corn pollination mid-July into soybean pod setting in the first couple of weeks of August. So this is setting the stage for a market that will be very violent and behave very differently. Some things that I want to remind everybody about. If we see the drought develop, and this does turn into another 2012 situation where we see extended drought across most of the corn belt, this will obviously cut into production and can cut production noticeably. In 2012, this produces prices that went north of $7, and briefly corn did trade above $8. This probably won't drive prices up as much this year. Global supplies in 2012, we were in a much different situation. We had seen a drought in South America. We did not have that strong production that we had this year. Right now, the world is pretty well situated with grain supplies, and that will at least temper old crop prices a little bit, and we probably won't see those same highs at least immediately. So this is going to create a special kind of volatility that may be a little bit different. And it also means that if you're paying attention and your crops are not at risk, you will get some marketing opportunities here where the markets begin to get overextended. Now, I'm going to go over a technical indicator right here, and this is something that we put in every daily chart, and that is the RSI indicator. Now, what this measures is whether a market is overbought or oversold. When it approaches the red, it's oversold. And as you can see right now, we're at 67.003. This red line on my chart is at 70. So we are approaching an oversold situation. That typically means the market will move lower. And when we go into the green, as you can see here, the market becomes, or excuse me, it's overbought up here. It is oversold down here. And as you can see, we are deeply oversold and the market bounced. One caution and warning about this. These markets can fall into these conditions and stay there for extended periods of time. So we need to be alert. And if you read the Tech Tuesday, another item I use is a stochastic, which measures the same thing, being overbought and oversold, but it's a more of a precision indicator. And when we get a cross on it, that tends to give you a better idea that it may be a selling situation. So again, we're in a market that has the potential to become unhinged. There's the other side of the story. If we do see rain come into the market, we do see a change in weather condition, there will be trouble for prices. Right now, I'm guessing yields are right around about 177 an acre, so we're going to lose 4 bushels an acre nationally. That will take our balance sheet down from a carry out of about 2,200 to about 1,900, so 1.9 billion bushels. That's not enough of a decline to stop weighing on prices. If we see that balance sheet drop to 1.6 billion or so, that's something that will be a level that will be supportive. For that, we're going to need yields to drop to 173, and we're going to need to be able to maintain export traffic. So while this is bullish for prices, we need to be careful about it. And keep in mind, the GFS model is going to keep putting rain into the forecast, and that is going to create volatility. The question becomes whether or not that rain verifies. And we have been in a drought here in Nebraska for the last 2.5 years. And this weekend was just like last weekend. Last weekend we were supposed to get rain Friday, Saturday, and Sunday. We got a little bit of rain, but most of the rain as we approached, the day of the forecast got taken out. Today we were supposed to have a 70% chance of rain. That's now been taken out of the forecast. Tomorrow it's 60%, and most likely it'll be taken out of the forecast. Along with that, depends on where the rain falls and how much it actually falls. And thus far, we haven't really seen anything. When we do get rain, it's been very light and not really constructive. Moving on to old crop corn here. As you can see, it is benefiting as, whoops, that's soybeans. We need to go to corn. July corn is benefiting, but it is not moving as much. And simply because this is about to come into delivery. Option expiration for this is a week. Actually, I think it's this Friday. It's coming up here shortly regardless. That means open interest is going to be dropping. And funds, when they come in and buy, they're going to be forced to trade either September futures, which is not one of their favorite things to do, or they're going to need to buy new crops. So as soon as we get this off the board, the better that will actually be for December. One other thing about fund participation, we don't have these very low interest rates that we saw over the last 3 years. Money is no longer free, and this creates a situation where funds, they won't be able to sell as many futures contracts as they were able to sell the last couple of years. They also won't be able to buy as many. This is also something that has some implications for wheat that I'll get to here in just a minute. But moving on to the soybeans, as you can see, soybeans, again, we are beginning to explode higher. We have a little bit of a different dynamic here. A lot of soybeans got planted early this year. We did a very good job getting the crop put in very quickly. In fact, this was the best year for putting a crop in early, with one exception, and that exception was 2012. Conditions were dry in 2012, much like they were for most of the major parts of the Corn Belt here. It was very easy to put the crop in, which it's always good to put it in, but that's always a sign that maybe something's not quite right. But looking at the soybeans here for November, as you can see, we're trading well above all the moving averages. We're getting very strong buying here. So when we think about things like pod setting, when soybeans go in early, they're going to be into the pod set situation early. That's where this July 15th, July 22nd, end of July drought monitor situation and where we are with precipitation is going to be even more important this year than it was in previous drought years like 2012. It will have a more material risk for the soybeans simply because they went in earlier. Soybeans, as we know, are incredibly durable. And even in 2012, when we finally got some rain late in the year, in the middle to late August, soybeans were able to make a little bit of a recovery. So yield ideas on soybeans are going to be a little bit different, but the risk profile for this year for soybeans is a little bit different from what it was in 2012. And moving on to old crop soybeans. Old crop beans, again, remain well supported. The export situation for soybeans, sales for old crop, this year is basically done. And our export positions and things are moving slower than they were. We didn't have as many beans, and China is obviously buying more beans coming out of South America than they have been out of Brazil in particular. And that's something that will create maybe a little less volatility within the old crop, and we will see volatility move sooner into the new crop situation. And I think really starting today, and depending on how the forecast plays out, is where we're going to see that volatility. So again, every farm is different. I'm not going to give any specific advice other than the way the futures market is going to act. Both markets are beginning to approach an overbought situation, and that will probably lead to some sort of correction. If we see any rain come in, it'll be violent. If rain doesn't verify in the forecast, you'll see a violent turn going up, just like we've really seen over the last couple of days. That is where the specific risks really lie within these two markets. And until the weather conditions change, meaning we get more rain, they're going to remain that way. You know, this is really probably getting to the situation where it's going to be a binary outcome. Either it's going to change and we're going to get rain and the crop is going to be supported, or it's not going to rain and this pattern is going to fall into place over the next 4 weeks and not really improve too much, particularly in the major corn growing areas. And that's where we'll see that sort of volatility. Some things to keep in mind. Monday is Juneteenth. That is a full bank holiday in the U.S., meaning the markets will be closed and there won't be any government reports. Tomorrow has become a bit of a holiday for the trading community. I am taking tomorrow off, and most of the trading community is also taking tomorrow off, making a very easy, sudden, unplanned 4-day weekend. So volatility will probably come down a little bit tomorrow unless there's some sort of drastic change in the forecast. So We're going to talk about something completely different now, and we're going to talk about interest rates a little bit. Yesterday was the Federal Reserve meeting, and what we did see was the Fed, after 10 straight rate hikes, has decided not to raise rates anymore. The thinking is we're going to stop raising now. We are going to see what the effects on inflation are coming out of this and whether or not we have actually cured the inflation problem. We did get the CPI and PPI numbers both yesterday and the previous day. Both of them came in better than expected. In fact, the PPI number was much better than expected. The producer price index PPI measures inflation on a wholesale basis, and we did see that actually print a negative number. So that does indicate that we do have inflation under control, at least for now. Inflation can be very snaky, it can creep back in, but if we can again keep energy prices down and get through another quarter, most of the inflationary pressures will come along and come down. What that means for interest rates. Mr. Powell also said that it may be 2 years before they actually start cutting rates. That is, a very long and potentially long time. He has always said that they're going to stay higher for longer. The real question is he will cut them if he has to, if something happens, if we see some sort of economic calamity, unemployment begins to move up noticeably, particularly in an election year. I hate to bring politics into anything, but that is a risk. But it looks like we're probably headed into a period of interest rate stability, assuming we don't see any more hikes. What that also means is the yield curve is going to normalize, meaning we have been seeing this inverted yield curve where nearby money is paying a lot more interest than longer term money, which is abnormal. We should begin to see that normalize over the next 6 to 12 months, meaning if you have money that you need to deposit, I would watch my time periods. I wouldn't stick it out too far, 30, 60, 90, 120 days will probably get you a better yield nearby, and then you can adjust as it is, because eventually that yield curve for the front nearby interest rates will come down and come down noticeably. As we can see today for the 10-year, we're down about 6 basis points. If we take a look at the 2-year, we're paying, 2-year will pay you almost 4.5%, paying 4.64. That's also starting to come down. So these rates should begin to back up. And we'll talk about energy a little bit because everybody knows the 4th of July is coming and everyone wants to talk about the price of gas. So right now, crude oil has come down meaningfully, and we did have a pretty good trading range between $70 and $75. Goldman Sachs came out with a report on Monday indicating that they're seeing larger production coming out of Venezuela, Iran, and Russia, and they are dumping crude into the market. This is offsetting the cuts from Saudi Arabia, and this is bringing more oil in, and this is going to begin to weigh on prices. Also, since we have moved past the debt limit problems, the federal government is now able to refill the Strategic Petroleum Reserve, so they will be in here buying. But it does look like we're heavily supplied enough that maybe our new trading range will be $65 to $70 a barrel. If that happens, we will see stable gasoline prices, probably about where they are now, maybe a smidge lower. The good news on that is that helps stabilize inflation, and we don't have all that extra volatility coming in, and that will make the entire economy feel at least a little bit better for the time being, which is, obviously a good situation. And since everybody also likes to grill steaks on the 4th of July, we're going to talk about something else that may not be such good news. This is a chart of live cattle. And here, we'll put this up here and show you a little something else here. Live cattle prices have moved up noticeably. We did see the futures market explode a little bit higher, and we've come off a little bit after last week's movement. But generally speaking, we are seeing cash cattle trade at some of their highest prices ever, trading north of 180 a hundredweight or $1.80 a pound. We have seen cutouts generally move higher in the stores. Cattle supplies are tight. This is something that isn't going to change overnight. And if we see persistent drought, this hits the cattle market in a couple of ways. While we're doing a lot better down in Texas and we're seeing a lot more rain there for the grass-fed portion, we've seen a lot of herd liquidation. It takes a long time to build the herd up. If we have drought problems, that's going to require basis to be increased in feeding areas. We're going to need to move the corn around more, and we may have tight domestic supplies, which helps price a little bit, but the overall export situation may be a little problematic. This will continue to create upward pressure on the cattle market, and this may turn into an extended market where we're looking at higher cattle prices for longer, meaning higher beef prices, probably stretching out as much as maybe 18 to 24 months. So this is something to be aware of. And also, as we begin this cycle, this is something that can hurt corn demand a little bit. And looking at the hogs, see, hog prices are beginning to recover. Hog prices have moved down noticeably. We're now trading back north of 90 cents a pound. Cash hog prices have improved, and this is the sign that we're beginning to see some consumer switching in the protein space, meaning beef for the whole group becomes a little bit more expensive. We see consumers putting more pork and more chicken in the shopping cart, and this is something that will become a habit after a while, particularly if we see prices move up. But this will be eventually supportive to the hog market, but this will be a process, not an event. So this will take some time, but we are beginning to see hog prices improve noticeably with that. And on that note, Ashley, that is everything that I had to cover. Other than I'd like to remind everyone, make sure you read the daily emails. They will be very important as the weather conditions are changing hour by hour, and we will see a lot of market volatility. Also, if you're not listening to the podcast, make sure you have signed up for the podcast. They're free. If you have anyone who might be interested in this sort of information, certainly feel free to share the podcasts and the emails with them. We're more than happy to help anybody along any way we can. And with that, I'd like to wish everyone a nice long weekend.